Hi everyone, it's me, Eric, from the Taiwan Institute of Economic Research. In this lesson, we will be talking about your financial forecast and how to prepare this key piece of information. Why is it a key piece of information, you ask? Because it is a way in which you can communicate your business and your mindset to investors. With that being said, always remember, a good financial forecast needs to be presented through strong and logical truth. From the previous lesson, we talked about what the components or elements of the income statements are. Well, those same items should go into your financial forecast, as this is your prediction of how the future income statement will look like. Because the investor will be able to use the financial forecast to see if your company fits into the industry benchmark. It is an item that they will ask for as part of their due diligence process. Through their experience, they will compare your company or your business using their metrics and models of comparables to see where your company stands. As such, the financial forecast is a good way to communicate with the investor about the direction the company is heading towards. Additionally, be aware that the CEO or founder of the company needs to be able to put this information together. Even if you may be mathematically challenged, the numbers are a component of the forecast, but you still need to understand the deployment of resources and strategic implications of your planning. As a face of the company, you must be able to, as mentioned earlier, be able to present the forecast through the lens of sound rationale and logic, where each dollar is spent should be thought through, and how the money comes in should also make sense. This should showcase the real master plan of your business. Some early stage startups may be asking, well, I have no revenue at the moment. How do I prepare this forecast? Well, the truth is, the financial forecast is not about demonstrating your revenue. It's more about the details you want to communicate to the investors and how in-depth you want to let them know about your operations. Furthermore, if you do not have revenue, especially for early stage startups, just show in detail and with good reasoning the how and why of your spending plan. Justify how the money you are planning to spend will help to grow and scale your business. Investors will appreciate the effort and thought going into this. In fact, if an early stage startup is forecasting high revenues in the second or third year, investor will sometimes get suspicious about how the number was settled upon. It should be realistic instead of assumptions. That's not to say it is not possible though. On the subject of projecting revenues, be wary that finding the first client is often the most difficult for a new business. As part of preparing the forecast, detail your plan on landing that first contract or first sale. This plan is oftentimes more meaningful than telling the investor how big the overall market is and how many % of it you are planning to take. If an NDA is in place or if it is not sensitive information, you can also let the investor know which client or potential clients your company is currently in talks with. For early stage startups, also be prepared to provide not only yearly forecasts, but also monthly projections or cash flow statements up to the first 2 years. Because yearly forecasts can be too vague and unable to capture some of the instability that comes in the early stages. In general, the financial forecast should cover the next 3 to 5 years. Good practice would also show, combined with income statements, that significant progress was already being made when bootstrapping, but this could be sped up with financing. Now that we've covered the context and considerations when preparing the financial forecast, let's make sure we know what to include in them. We already know that they need to have items from the income statement covered in the last lesson. So what else should we add? Well, in preparing the forecast, starting with your expenses, not the revenue. Figure out the fixed costs and overheads that you are anticipating, along with the variable costs. Next, for revenues, include both a conservative estimate and an aggressive forecast. Again, remember to have sound reasoning behind both of their numbers. Finally, utilize metrics and ratios to ensure that the forecast makes sense. Make sure to check the following: gross margin, sales and marketing expenses as a percentage of revenue, and general admin expenses as a percentage of revenue. Here is a sample financial statement or forecast. For investors, this one document can tell them a whole story about the company and where it wants to go. Make sure you are communicating a valid story through this document. This brings an end to the lesson of financial forecast preparation. You should now know what items to include and why they are there. This is the final lesson on financial planning. Be sure to check out the other videos on due diligence and key terms and saves. See you soon.